So I'm going to be sort of trying to wrestle the best out of these guys and on the subject of capital adequacy, and it's a topic that keeps popping up from time to time. Is there enough capital in New Zealand to take the companies that we've invested in forward? And you have perspectives from both extremes. Look, there's plenty of capital, the right ventures, the right startups, the right companies, the right entrepreneurs will attract the capital. So there's plenty of capital, and let the others, flounder. There's plenty of capital, we just haven't got to it. There's another thing we hear. There's a significant capital locked up in families, the rural sector. Let's surface that and apply this to the companies. And others would argue there's totally inadequate capital. There's that big dip. We've got deal flow out of accelerators that can't be met. Most of companies that we're involved with are undercapitalised. And that's why that follow-on activity is challenging. So we'll have a discussion around adequacy and capital adequacy and what that really means. So what I'm going to start with is just a brief introduction from each of the folk on the panel, and thanks for fronting up.
With that as well.
But I'll make sure it's brief. So just about yourself and who you represent, and then we'll address the adequacy question. Bill, do you want to lead off?
Sure. This is working. Bill Murphy, and on this panel I'll wear the hat of...
Okay, that's it.
Angel. I'm wearing a hat. Angel Equity. And that's it?
Good. That's it. That's enough.
You guys know me.
Man, that was quick. Will Equitize, Trans-Tasman Equity Crowdfunding Platform.
Simeon Burnett, co-founder of Snowball Effect.
Chintaka, Managing Partner of Global from Day One, Series A Focused VC.
Bridget from Seedco Investment Fund.
Simon Brown, GM Accelerator Services at Callaghan Innovation.
Mark from Movac.
Duncan, Brandon Capital Life Sciences Venture Fund out of Australia.
Excellent. Okay, thanks guys. Well, you see they've got a piece of paper here and a pen, and I've done that deliberately because when you ask someone a question and there's a crowd of this scale, then there's this tendency for the following respondent to either agree, investors are followers, right, or to radically disagree. But Ray's not on the panel, so it probably won't happen. So to remove that risk, I'm going to ask the panellists to write a number on the piece of paper and then to hold it up. And I'd like you to think about, and we could put some parameters around it, the capital you believe is required, so capital adequacy, to take the businesses, the companies, the deal flow, to capitalise on the opportunity that you see, whichever sort of parameters you want to put around it, and you get an opportunity to explain this in a minute, but let's say over the next 5 years, what do we need in New Zealand to take the companies that you're aware of forward to their full potential? That could be exit, that certainly liquidity is baked into that conversation. So the next 5 years, write a number on that piece of paper without looking over each other's shoulder. Robbie?
I don't think looking at Robbie's would be helpful right now.
Have you all got a piece of paper? Yes, you have. Will, you got one? So I'll give you a couple of minutes to think about it, because we'll be delving into your rationale. So how are we looking? So you're all ready to put up a number for public scrutiny? All right, let's hold up your charts. We've got 60 million times 3, so that's 180. We've got a sheep. What's a sheep?
It's a sheep cat. You need both herd sheep and herd cats.
So how many sheep are there? 30 million? Worth about $25 a head, aren't they, sheep at the moment? Something like that, maybe a bit more? Yeah. So you're suggesting 30 million times 25? Something like that? Is that your number?
Well, I think we just need as many sheep to herd in and help with, I don't know what the final number is.
People, right? How many people do we need? 2.5 billion?
I mean more in terms of
In terms of adequacy, I think there's a question between money and then what we've been talking about in the last few days, but actually contributing to a company in strategic value as well.
Not disputing it. If you were to put a number on it in terms of dollars, what would it be? Come on, guys.
I changed mine myself.
I think it sounds a bit arbitrary to attribute an exact figure to it, to be completely honest with you.
All right. 2.5 billion. Shintaka.
5 billion.
5 billion.
Yeah, for 5 billion, so $1 billion a year.
Capital adequacy.
Take into account later stage kind of investment, enough institutional support for that exercise.
All right. 5 to 10 million per company. All right. 500 million. That's a good number.
Yeah, so 10 new businesses per annum, needing between 5 and 20 million each, 10 million average. So I've put here, plus collaboration and defragmentation, because I think if we leverage some of New Zealand's unique context and ecosystem, that you can actually multiply around that 500 million substantially through ensuring that we're lined up as an ecosystem and supporting those businesses. And therefore, you definitely need the people and the collaboration wrapped around that money.
All right. Mark. Snap.
The rationale for mine was, we'll deploy 125 million over the next 5 years. That'll be alongside co-investors, so that gets you to 250. In the context of our fund, that's 8 to 10 deals. So the balance of the 250 is all the deals that we can't or won't get done.
Okay.
So mine was a caveat, 100 million. I'm interested in life sciences. I don't pretend to sort of have an opinion on everything else. So I reckon 100 million over the next 5 years into the life sciences space.
Okay, thanks. So do we have a winner? What's the audience view? Any comments? Any questions?
It always takes more money, so I know what's the target. I would have said 10 motions,
Yeah, I think it illustrates the sort of challenge associated with trying to quantify the number. And in fact,
Marcel, you start talking about debt as well. I mean, sort of focused on equity so far.
yeah.
When you start talking about capital adequacy for debt, then the numbers just push higher again, right?
Yeah, I mean, it's because you often get asked, what is it going to take to scale these companies? And then there's so many variations on the theme, so many different interpretations, and I found it fascinating, sort of the wide range of perspectives. And in fact, we sort of don't know to some degree, and it's possibly something we need to get a better understanding of. It's very difficult to sort of fill that theoretical, dip in terms of growth capital without having a perspective on what it's going to take, where we would apply it, and potentially what the outcomes of that exercise would be. So I thought that was sort of interesting. So I just want to, Shintaka, do you want to comment?
I was just my rationale for the 5 million figures. Look, it's somewhat arbitrary, but there isn't a single successful startup ecosystem globally where you've got where you haven't got a lot of money behind the big winners. So, and as Trevor pointed out, it takes a lot more capital than people think. So, look at any billion-dollar company, and it's had significant later stage capital put behind it.
Well, and I agree with that, because I think of all the funds that have recently been announced, if I remember correctly, Singapore has just announced $1 billion fund. If you look across it, and Singapore has just announced $1 billion fund, all of these countries are announcing these really large sums of money. Now, whether that's money well spent or not, I think there's a real argument about it. I think New Zealand does a lot more with a lot less. But I think we often do a lot less than we actually could get away with, because we have a tendency to talk about, oh, this company can do it for 5 million, or this company can do it for 10 million, and then you go to another company, and I'm always amazed when I see these ones. This company got funded for $45 million, they ran for 18 months, and then they ran out of money. And you're thinking about, what could you do with $45 million here, not alone that. So I think the numbers are bigger And I think we massively undercapitalize for that. So I agree. I think it's the bigger, it is that kind of billion-dollar sum.
Yeah, I would absolutely agree. And, the thing with the Singapore billion-dollar example is that's purely their smart cities fund. So Singapore is pouring tens of billions of dollars a year into it. And, I think going back to Sir Peter's bribes comment, Singapore has been successful as an ecosystem by pouring vast amounts of money into the tech sector. And you could call it a bribe or whatever you want to call it, but you can't argue with the fact that it's been extremely successful.
Well, I was there 2 weeks ago, and it's massively successful. I mean, in the last 15 years, they have gone from where we are, I suspect now, to what, and they're building huge amounts of infrastructure and things like that. They're putting in huge amounts of money, and I think if you don't have that, I talk about the upstream. If you don't have that upstream, you're never going to get the downstream to it.
I just want to clarify my point. Maybe I've undersold it by 5 to 10, maybe it's 10 to 20. But if I look across, our portfolio and how many companies have actually raised more than a couple of million, it's not very many. So I think, it's great to have a really aspirational goal. Yeah, we need to deploy 5 billion or whatever it is, but we've also got to start somewhere. And I think we need to start looking at some of our companies. And we talk about going global from day one. I think, what Brian Russell said yesterday, we've got to be going exit from day one or liquidity event and planning for that. And so, we've got to look at the companies we've got in our portfolio and making sure that we've got funded them enough to get to where they need to go. So that's sort of my look at it from a company by company perspective and make sure we're giving the good companies the money they need to do what they need to do.
I sort of put the 5-year parameter on it. I mean, I'd find it very hard to find enough quality deal flow to invest 5 billion over the next 5 years. I could see it, longer term. So it's a question of what can we focus on in the next 5 years to build up the credibility and the momentum to be able to attract, much more significant capital in the future. So there's that trade-off between sort of over-investing and not having, what it takes to apply it productively, versus, under-investing, which is essentially where, we see ourselves today. So I just want to carry on with your rationale, if you like, and we've touched on some of that, and sort of extend that conversation into dependencies. So what else would it take? What else is required to be able to live up to deploying the capital that you've proposed we need to be deployed in the most efficient way? So just start to extend the conversation in that regard, and I think you've already touched on it, Will, with respect to the human capital component. There's no point having the capital if we can't actually, make the best of it. So, Simon?
I was going to make the point that in addition to a 500 million fund, there's actually a ready source of investment in businesses for support of R&D. Back to Sir Peter's challenge before about not only funding PhDs into businesses, there's up to 5 million a year available to do that today. But over that period, Callaghan has access to $800 million worth of R&D grants to support businesses. And demand does definitely not exceed supply at this point. So I guess for businesses thinking about how can they focus on a more intensive focus on R&D, leveraging the money that's available to assist the growth around further capital raise as well.
So just to extend your comment, and maybe you could speculate on why that supply, if you like, or the demand, if you like, has not been picked up. What's the dependency or the critical success factor that's undermining or underplaying that opportunity?
I think there are a number of factors. I think too few businesses take a structured approach to R&D and innovation. So the, RIP number 8 wire and the garden shed, coming out of the garden shed, fiddling around for 3 years and then expecting to go global is not relevant anymore. You need to be born global and think from that point, and that includes your R&D and innovation plan. So we see a lot of businesses who we can offer services and programs and support to helping open their eyes to that. So I think that's the first thing, is a change in sort of attitude towards it. I think there's also some things that we as an agency need to do to assess the ease of the access to that capital or to that investment. It hasn't been as easy as it could be, but we're certainly working hard to try and change that. So those, yeah, and thirdly, trying to understand the needs of individual sectors and amending and influencing the parameters around some of those grants programs so that they better suit the needs of an individual sector, because currently they've been a little bit plain vanilla, one size fits all, and the definition of an R&D and support in digital and data may be quite different to that in food and bev or agritech. So we're working hard to try and understand that. So those are probably three factors that I'd point out.
Mark?
I think my observation would be I probably see 150 deals a year. All of those conversations to start with, the premise of the business, what the exit might look like in terms of who, why, and when. 1 in 20 entrepreneurs would have actually thought through how much cash will it take me to get to that point. At what point will they be raising? At what value? And the justifications for those step changes. So I think a lot of folks are investing early stage, not really understanding what the requirements of that business will be right the way through to exit.
Robbie?
So is this a debate about whether we need to sort of go it alone and fund all the companies as New Zealand or not, or is it saying we just need to access more capital offshore to
Absolutely. So leading into the next point,
Oh,
which
sorry.
is so how. Yeah. So you say you're going to front up the raft of sheep, but let's say there's a we're settled on 500 million, $1 billion, whatever the number might be. So what are the dependencies? How are you going to make that happen? Now clearly that might be from onshore or offshore capital. So now you get into the strategy. How are we going to attract that capital? So what are the critical success factors that you see are going to underpin the number that you put up there? But you've got farmers.
I've just given a flippant response because I fundamentally, I'm on the end of the spectrum where I think the entrepreneurs will navigate and find the capital, right? And you can't solve everybody. Entrepreneurs aren't affected by macro conditions like the top ones. They're the ones that sort of, despite being 2008, they're raising big rounds when there's no money around. 2007, they're starting great companies. So if you look at ADI or Crimson or Predict or Lanzatech or Zero or any number, Rocket Lab, they find the money, right? And so then the question is, I guess the debate is, are we impairing other ones because we haven't paved the path for others to follow in that? And is that because the money's not here or they just don't know how to access it?
But I think to some degree it enters into the debate that Sir Peter was, I suppose, proposing around R&D, and to what degree the government has to act as a catalyst to create the flow in the river. Capital adequacy to some degree is like that. You need some capacity to be able to support the ecosystem, despite the fact that there will be outliers, exceptional entrepreneurs that will always find the people, always find the capital. So I think that's the challenge we face. So to what degree do you need to seed it to provide enough momentum so that over time it becomes self-sustaining? And he settled on 0.8% of GDP R&D is the government responsibility. So what is our collective responsibility, with respect to capital, to take all these initiatives that, granted, often are still on a learning curve, to the next level. Bill?
We're all agreed that these companies that we're investing in, their markets are offshore. We are also aware that our capital markets here are very shallow compared to offshore markets. And so in some ways it's very obvious. We need to get our companies offshore quicker, in market where they can actually scale, because that's where they need to be, and also in those markets where they can attract that further capital so that they can grow. In a recent trip to the States, I was really pleased with the response and the genuine interest from VCs and a whole range of people here in the United States, particularly around New Zealand ag tech. There's all kinds of ways in which we can get our companies into those markets, and that could be one of the answers to the capital question. In terms of how we invest our money here in New Zealand, we've just got to make sure that we're applying the lessons that we've learned now over 10 years of doing this stuff to put more money into the better companies and less money into the wannabes. Spraying money around, we don't have the money to spray it around.
Any other comments on CSF's critical success factors, dependencies? Shintaka?
So, you know, I agree with what Bill was saying, largely. So I think for me, a critical issue with the ecosystem is that a lot of the seed and angel funding round sizes are just too small, particularly in comparison to US norms, and even allowing for the massive difference in cost structures. Often you see too many companies that have raised too little money that have too little runway, right? So they're often not set up to succeed, and that's driven by you know, a lack of local capital at the early stages.
Samir?
Yeah, I think, you know, one of my observations probably over the last year has been just the lack of education and probably financial nous within companies when it comes to thinking about raising capital. I think there's a real lack of a go-to spot for companies when they are thinking about raising capital. A lot of companies that haven't been through angel rounds for whatever reason, haven't been the right type of company or just haven't chosen to go down that route, they sort of haven't come into an environment where thinking about raising more capital is something that they're constantly talking about at a board level, having the right people at the board level to be saying, hey guys, we should be starting to think about that now. So I think there's a big opportunity in New Zealand for someone to step up and sort of be the go-to spot for companies to talk about raising capital. And that may be through angel networks, and it can be for companies that are beyond the angel scene. And they may not be going global, but they can be really good domestic, highly profitable businesses. So there's a whole range of things there, I think. But I think for me it comes down to education and being able to talk to people who can support those businesses and being able to do that in a really efficient manner.
Any other comments on dependencies before I move on to the next question? Duncan?
Just probably make an observation on you know, I think we've been very good at starting opportunities, and what I'm seeing, and I am very much in the life sciences space, so very specialised, but what I'm seeing is that people aren't looking at the long game. You know, life science in particular is a long journey, and you know, you do need pretty deep pockets, and so it's great to get something seeded for a couple of $1 million, but then how do you get in the clinic and how do you really build some serious value for New Zealand? And so I guess that's sort of an observation of some of the things we're seeing. And I guess I'm biased, we're an Australian fund, but just looking across the ditch, 3.5 hours, and Jordan, perhaps you could comment, but at NZVCA a couple of weeks back, something close to $1 billion in venture is sort of moving into the system in Australia, and that's 3.5 hours away. So I actually think we need to sort of stop talking about needing more money and actually just get our track record up. You know, get some of these exits. I mean, we talked about exits all yesterday, and there weren't that many hands going up saying, yeah, great. You know, and that's what more investors come in for. That's what attracts deal flow, it attracts entrepreneurs. You know, I think that's what we need to focus on.
So, any questions from the floor before we move on to the next discussion? Observations? No? So the next point I just want to have you touch on is your contribution to capital adequacy. So we'll start with Duncan. So what is you yourself, your organisation, what are you contributing to capital adequacy in New Zealand?
Well, so we, for those of you who don't know me, Brandon Capital, we're a $200 million life sciences fund. So we have the ability to go very, very early into research assets and then take them through into the clinic. Our LPs have the ability to put another 35 million on top of that into each investment. So in the space that I'm in, I actually feel really good about the amount of capital that's available for the right deals, with the right trajectory and the right plan to get to the clinic. So, yeah, I think we're in a good space.
In terms of our contribution, I think it's scar tissue. 15 years of actually understanding how much things cost to fund. If we look at one of our portfolio companies, Powered by Proxy, that's had more than $30 million worth of investment. We went in there literally at seed stage 8 years ago. And you learn a hell of a lot along that journey in terms of the ups, the downs, the sideways and the cliffs. And I think recycling some of that experience and providing that to entrepreneurs and investors at the start of that process is actually quite useful.
I've already touched on a couple of things in relation to the grants area. Obviously, our ongoing support of the founder, the tech incubators and the accelerators. Hopefully that's helping to contribute. and also other programs, international delegations, and which we can support businesses who are looking to head overseas. So we're about to take a delegation of 15 companies to CES in January. So, you know, those are ways that we can maybe help, not directly through capital, but I guess in helping them on that journey and co-funding them along the way.
As everyone knows, SCIF is under review again, and we're working really hard in engaging the government in terms of ways in which we can leverage what we're doing now and kind of just tilt the goalposts, I guess, just slightly to be able to meet the need of what the market requires. You know, it is business as usual for SCIF, and we are continuing to do, you know, our role in market development, where we're signing up new partnerships, which I think is really important in terms of our regional focus and for those companies that aren't in the big centres. But it's also about having the ability for SCIF to follow those investments that are going to help return and provide the support to the investors that are funding these companies, you know, for longer than perhaps they were expecting to, and continue to be kind of that surety of capital, which I think is kind of the fundamental role in which SCIF can play, and you know, looking at ways in which we can kind of enhance and make it more efficient what we're doing, and better meet the needs of the market and where it is now versus 10 years ago when we were set up.
So we're quite specialised in what we kind of contribute. We're generally doing half of a Series A round of 3 to 5 million into companies that are often angel-backed and have had several rounds of angel funding, often been around for 5 to 10 years, and doing, say, 1 to 5 million revenue. And really, we're investing into growing global sales and marketing with a view to, and providing companies with 2 or 3 years runway, with a view to getting them to generally a big Series B of 10 million plus.
Yeah, well, our vision really is to sit in that space between, I guess, where the angels stop and where the major brokers kick in. We see a real need there for not only capital, but also expertise to be going into those sorts of companies. So we want to be providing those companies with various funding options, as well as working with a wide network of people who can step in, not only invest in those companies, but also get actively involved and really bring some expertise into areas where they need it.
Yeah, ours is picking up on a theme that's been running through the conference, which is facilitation and access to capital. So on the access to capital front, we've been providing access into our wholesale network in Australia. So recently did Ralph Stewart's Retirement Income Fund, which we raised or helped raise. Still going? Thought it cut out for a second. We raised and helped facilitate a raise of 1.7 mil, and 25% of that came out of our Australian wholesale network. So it's creating access to capital for those companies, but also facilitation of the angel network and the network that we have, and collaboration. I mean, this panel should be about collaboration as well, and different funding options working together. So another transaction we did was a top-up round for the One Above flight drink company, which is, you know, funded by Movac. And its focus, in part as well, it's what Bridget was saying too, picking up on these companies and looking at the ones that really need that capital, and making sure that we're all on board providing a funding option together for those companies that are going to drive New Zealand Inc. forward. So focus as well, and facilitation as well as access to capital.
Well, I guess I've been really excited seeing the democratization of access to the space. Like the extreme view is on the extreme end of the spectrum is the crowd, and they get a lot of flack. But behind that, or beyond that, like if you look at when I started, the average ticket price was like 40 or 50 grand within Ice Angels per round per company. Now it's down to 19,000, and we've got these funds that, like the 4 showcase funds and Tahua, that absolutely open the door for people to get a bit of exposure and then invest further, and they're absolutely doing that. And so it's a more user-friendly way to get into the market, and our observation is a lot of the folks that are chipping into funds aren't doing so based on sort of limited capital capacity. It's just on a preference to dip your toe in first and then invest more in subsequent rounds. I guess the other thing that's exciting is seeing the influx of international capital in the Aussies. We've just done 2 rounds with the Melbourne Angels, where it was sort of $300,000 plus in both. So more of that would be great.
Angel Equity is a platform highlighting angel and experienced early-stage investor deals with all the due diligence and investor protective terms, all the stuff that we do, making those deals available to wholesale investors throughout New Zealand. So in the short term, that's the plan for Angel Equity, which is to make available the kinds of deals that we invest in and that we back are available to wholesale investors throughout the country. A second part in terms of capital adequacy for Angel Equity would be to assist with the syndication and the facilitation of deals between the angel groups themselves. Our processes are a little bit lumpy, and if we can use technology to try to speed that up, that'll probably be a good thing as well. And thirdly, having the site be a showcase for people like NZTE, NZVIF, those that are having conversations with capital partners offshore, to be able to highlight and show them the early stage deals, angel-backed deals that are in New Zealand, so that those parties can come to a place and see a good cross-section of the stuff that we're working on to try to attract in those capital partners.
Great, thanks Bill. I want to get on to outcomes now, outputs, results. So we spoke quite a bit about this yesterday, what's motivating investors, there's often the soft issues, NZ Inc., giving back, learning, passion, shouldn't have said passion, midlife crisis, whatever. And there's really, that sort of pressure, certainly rhetoric, if you like, that the Angel Association's been progressing over the years, to be more active around your portfolio, be more engaged, be more professional, extend that due diligence lens, beyond the sort of once over lightly at the start to keeping that live on an ongoing basis. So we need to sort of shift that focus to results, financial results, because without financial returns, we can't keep and sustain, whatever reason, underpins why we do this stuff. So I'd be interested from the group, and grab your piece of paper. We'll see how creative they are this time. Off the back of that investment, off the back of that capital, let's assume adequate capital, what do you expect to see as a return? Ideally an IRR number, but I'm sure I'm going to get a lot more than just an IRR number from the group. So a couple of minutes to think about, what does success look like? I'll just start. I can't think of anything to draw or write that makes sense. Yeah, that's the extent of my drawing skills. Yeah. The interesting exercise that we've gone through with pooling a bit of capital into HUA is all of a sudden you try to look at returns across a portfolio where, we had plenty of companies that the Ice Angels had invested in, but we had never looked at it as a sort of single portfolio and what the IRR would be, in 10 years. And the thing that strikes you, and I'm sure Mark's done this, is the reason you would do the modeling is to look at carry, right, which is saying I've got to grow the fund and return capital. And the only way to keep this place going, or to keep a fund going, or anything, is returns beyond what you can rationalize, right? It's not the returns that Rob Wiltbank says you're going to get, and it's not the sort of standard outperform the liquid market. It's just unimaginable growth, and it's usually from 1 or 2 companies. And at that point, you just give up on the modeling, because there's no point of saying, oh, this one will give you 3x and this one will give you 6x. And
I think we got to be above board in this game. Otherwise, we're just economic development. So, angel investors have to be making money in this space eventually, and through what we do, or people that invest in this space need to be doing that. But I think I agree with Robbie. Look, if we really knocked one out of the park, that would last us quite a while in terms of spirit and motivation. The green button did that for us, for lots of us. And, we've dined out on that for quite a while, and we're being kicked out of the restaurant now on that one. So, we really need another one, just as Robbie says, one that just, makes our eyes water and we go, God damn, this can happen in this space. Wow. So that's my contribution.
Will?
I just think that's an interesting point as well about the difference between a lot of the focus of the last few days has been on exits and financial return, which is a fundamental value that we as a platform have because we have to give economic returns to shareholders for them to keep coming back to us as an investment platform and using us. So that's a fundamental value proposition of what we do. I do think it's also important to mention what was said before, though, that this as an industry has a huge social impact and social development impact on society and the creation of jobs, of learning processes. And I don't think that should be just undervalued as well. I know that we're about financial returns and it is an Angel Association conference, but the amount people learn through going through these processes and being funded is a fantastic thing for New Zealand Inc. as well. But yeah, we are a financial returns industry, so I totally understand that.
I'm just going to jump in. Sorry, I got one more thing to add before you go. So my question yesterday of why people were investing in Parrot at a $22 million valuation is exactly to this point. It's what Brian was talking about, right? Like, there's only so many things you can control, and one is entry price. And so if you have two buckets of capital and you've got your angel bucket and your venture bucket, then it's fine to put money, in my opinion, out of the venture bucket into a valuation like that, because you can say, oh, maybe I'll get 3 or 4 times. But in terms of a solution or a tactic in this context, it's like definitely stop funding companies saying, I think this would be a good 3x, right? If it's in your angel bucket, or invest at a valuation that gives you more opportunity.
Yeah, I guess just to answer your question, Marcel, around IRRs, and I think, when you consider this kind of thing, you need to be thinking about the spectrum in terms of the capital landscape in New Zealand, not just angel type investing. So I guess assuming that you had a sensibly weighted portfolio right the way up to kind of a listed company down to seed stage, I would have thought something like 20 to 25% IRR would be what you're gunning for. I think probably one of the major challenges is really just getting more New Zealanders thinking about that kind of stuff, getting cash out of property into these sorts of companies, whether they're angel, whether they're seed, whether they're listed. We just need a whole bunch more people in this country that are actually keen to back other Kiwis, back stuff that actually employs people, and stop a lot of these firms going offshore, because that's the reality of it at the moment.
Good.
I'm going to be more controversial, as you asked, and I guess I would say we target a 50% plus IRR, and part of the justification for that is really, if you look at New Zealand private equity, it's actually been performing historically at over that 20% IRR level, and in the early stage space, we should be seeking more across a diversified portfolio. And probably in terms of reinvestment into the ecosystem, also looking more at secondary liquidity options rather than wait for the eventual exit 7 to 10 years down the track.
What I think success looks like is we talk a lot about NZ Inc. And I question whether we are truly NZ Inc. So success for me would be actually us, hand on heart, saying we were NZ Inc. We were all working collaboratively together. We were cohesive. At SCIF we say end-to-end seamless investment solution. So it's government agencies working really well together to each of our strengths, which adds value to the ecosystem. with all the expertise that's in the room, all the angel groups leveraging each other, syndication, so that we are funding those great companies to go on to do fabulous things. And also, I think there's a huge amount of responsibility on the people in the room, because you guys are the active angels. So I think it's also about working out how we grow the active angels and the lead investors that we've got that can work with these companies. And so my sort of what is success, it's, if there were 5 times as many active, engaged and lead investors in this space that were helping these companies go on to achieve those great things, then an IRR of 50% or more could really be possible.
Yeah, I completely concur with a number of the points already made. I've already touched previously on what does success look like in the NZ Inc. thing. I think the change to culture and attitude towards innovation and R&D and what it means to be an entrepreneur, and accepting dilution for growth and accepting the health and the mentoring and coaching. The second thing is that, as we all know, creating individual businesses of scale out of New Zealand is very, very challenging, and I think we have to work better together to create sectors of scale and focus on where is our natural advantage and competitive advantage in the market to grow sectors of scale. And to do that, we have to embrace collaboration and co-opetition. And we see it every day from certainly in our role, that even though we talk about NZ Inc., day to day people are trying to step over one another. I mean, natural competition, that's all cool, but we could do a much better job as NZ Inc. So some sort of results of that: business expenditure on R&D at greater than 1.5%, which means we need to increase that spend on R&D by $2 billion, an IRR of 25%. I'd like to see the GDP, more than 40% of our GDP made up by tech-based or knowledge-based industries rather than tourism and primary. New Zealand truly recognised on the global scale as an innovation nation, so take the best of Silicon Valley and Israel and all the other things and apply our unique New Zealand context to stand apart in the world, the most globally connected innovation nation on the planet. And finally, making sure that the New Zealand First 15 is not the All Blacks, but it's the 15 tech companies that we work collectively together every year to take onto the global stage and wrap the love, care and attention around them to ensure their success as NZ Inc., not just as individual investors.
So mine aren't too dissimilar from what people have already said. So, obviously returns number one. Secondly, it's the recycling of the talent and the money to go again. So that people don't have one success and then head to the beach and stay there, or at least more than a long weekend. The other thing, in order to do that, we need to speed things up somehow. So, 10, 15-year overnight success stories are really quite debilitating. You look at your peers and your counterparts offshore, they're working on 3 to 6 year cycles. So how do we get better at doing that? Tying in with Simon's point around, what are our sweet spots? What's our USP? There'll always be general stuff, but what can we have, some sort of competitive advantage around in terms of a market or a niche that we can be known for? And then obviously with the selfish hat on, we need to keep delivering results so we are a sustainable fund manager in this market.
Yeah, so from our perspective, we wouldn't have raised money based on passion or fun or whatever. It's purely financial, right? Superannuation funds don't come into this just for shits and giggles. So from my perspective, at an individual company level, an investment level, we're shooting for 10x every time. Now, we're not going to get that, but we have to start at that point. We're a 15-year fund, so we're looking for around 35%. We're sort of shooting at that at the moment across our funds, 35% IRR, and that's a 15-year fund. So, that's what we're aiming for. And I just come back to the only caveat on, we absolutely have to make money for our investors. There's no choice there. The luxury I have is that if I make money for our investors, I actually make a difference to people's lives, and that's the advantage that I have. So I get to do both. It's cool.
No, thank you, Duncan. I mean, it's fascinating, isn't it, to try to shift that conversation from inputs, from that engine that we're really cranking, to quantifying what success looks like and really getting some hard numbers around sort of financial performance. That's a shift that we want to drive. I mean, it's not an easy shift, but ultimately you have to drive that shift towards outcomes so that we can continue to reinvest time, effort, money into the startup companies that we're excited about. So I think this conversation is going to continue for some time in terms of framing that up sort of on a collective basis. And we all play a different part. We all play a role in that continuum. We're all motivated slightly differently, but united under an overall sort of, I suppose, umbrella. Rod, you got a comment on New Zealand's capital adequacy and what success might look like? How adequate are you, capital-wise?
We haven't found any problems. I think there's more of a entrepreneur shortage and all of that capability. Yep. So just a few general comments on the morning. What we've learned, I think, is that, and we had a fantastic session with a whole bunch of New Zealand CEOs with KPMG and ASB. One of the things that we found, our unique New Zealand characteristics are fairness, and that sort of corporate welfare, too much investment by government is really hard to do here. What is frustrating, though, is we don't use our small size to build to sort of infrastructure and the base platform things that allows innovation to thrive. So we're very hands-off, which was one of the first discussions this morning. So one of the actions that came out of our session was, again, pushing this idea of a CTO for New Zealand, so we can pick some of the really big things that need to be done. So what are we doing with electric cars? What are we doing with comms? What are we doing with payment networks? Because if we can design our experience to be good at all of those things, then we do get innovation characteristics starting to happen on top, and then international people and some of the multinationals do start to come down. Some of the interesting things we're seeing at the moment is some really good regulation in the UK. They've done something called their Payment Services Directive, which has forced the banks to have open APIs. So the amount of fintech opportunities that are happening in that market is huge, and global money is starting to flow into that. So it was a good example of where the government has done something which actually drives a whole lot of innovation. So it just frustrates me that the government is kind of hands-off. We don't really want money from them, but we do want to work as a tight team to do things that allow us to build great companies over the architecture that we design New Zealand to have. And we're completely passive about it, so we're missing the opportunities, if that helps.
Thank you. Any questions, comments? No. I think that's the other observation, perhaps in something that came up yesterday, and I think one or two of you have touched on it, is that a clearer distinction between economic development and investment. I think Robbie, Will, others have said, look, there's an economic agenda here, an economic development agenda that we need to continue to drive. And some of it's got some, is a little softer than a pure play investment decision with a IRR and some sort of return profile. And we've sort of had a continuum of that, in some of the perspectives from the panel. I think we have an opportunity to make that distinction clearer. With the data we're starting to surface, with where time and effort's being expended, we're able to go back to government and help them, clarify that distinction as well. Get them to focus on economic development and levers, such as some of those that Rod referred to, enablers, policy levers. Again, some of them relate to tax, the ESOP conversation earlier on. They're all related to socio-economic development to enable us, to professionalise the investment conversation. So we'll certainly put that high up on the Angel Association agenda next year, and to surface the data points that highlight those two dimensions. And that will also clarify accountability, also clarify what success looks like. I thought it was absolutely fascinating. It shows you that it's work in progress. It's bloody hard to sort of quantify this stuff. It's still more art than science, which we all know, but I think we need to build more science into this for us to be credible globally. We need to be able to take some of this on a factual basis to investors offshore, and I'll see this this journey continuing for some time. So hey, thanks guys for fronting up. Really appreciate the input, and we'll move on to the next session.